got some fabulous people like Bob today to actually help us learn more about investing and the venture process. So with no further ado, I'm going to introduce Roger, who's been kind enough through Procopio to give us the venue. So would you like a few words?
Well, thank you everybody for coming, and Pamo, thank you for allowing us the opportunity to host this event. The lineup today looks absolutely stellar, and
especially the later lineup.
No.
Yeah, I think I'm for one definitely looking very forward to it. So we've got folks in our other offices in other cities all hooked into the streaming, so that should be great for them to experience this event. Just a couple of quick words about Procopio so we can pay for breakfast. We're a full-service law firm. We're headquartered in San Diego, and we actually love the Bay Area so much we actually brought our clients up here. Cynthia just moved all the way up to the Bay Area, relocated, and it's fantastic to be able to service our clients up and down the coast. I'm the leader of the Emerging Growth and Technology Practice Group. I focus on startups all the way through the life cycle of the company through IPO. And that's really it. So enjoy the event, and thank you all for coming.
So if anyone wants to talk to Roger, he'll be around most of the day, I think. So I'd like to introduce Bob Pavey, who's an emeritus partner at Morgenthaler and a wealth of experience. I did video interview him at NVCA VentureScape, which is the National Venture Capital Association event, and I was fascinated, but got a lot of things wrong as far as transcribing it, but Bob was kind enough to help me. So we're just going to start this fireside chat or coffee chat, and what we're actually wanting to encourage everyone to ask questions of the speakers and the roundtable contributors. So there will be at a 30-minute break, it'll be open for you to ask as many questions as you like. So please take advantage of that. We are live streaming it today, and I've reached out to a lot of international media and out-of-state media, and we're encouraging them to actually ask questions via the live stream feed. So they will take priority. I hope you understand, because obviously they weren't able to attend. So you'll find that there will be questions coming through the live stream feed. So thank you again, and over to Bob.
Glad to be here.
Well, Bob, I know what really this is so high. What really fascinated me when I first met you was the fact that you have such huge experience in the Valley. So you've seen it go through many stages. So I was wondering, first of all, if you could tell us a little bit about what your focus has been during those years of being a venture capitalist here, and a little bit maybe about how Silicon Valley works.
Okay. Maybe it's best to kind of start at the beginning.
Okay.
Very quickly, I promise. So the venture capital industry is a post-World War II phenomenon. And after, in the late 40s and early 50s, some wealthy families back in New York, the Rockefeller families, hence the firm Venrock, and the Whitney family, and the Phipps family, which started Bessemer, were, if you will, angel investors. And people would come to them, entrepreneurs would come to them that needed serious money. These were the places where you could get serious money from people who were willing to take a risk. And they institutionalized that and became venture capital firms. That was basically the 50s. Then the industry, actually the government got interested in venture capital, and they created these things called small business investment companies, SBICs, that were licensed by the Small Business Administration. Most of them were kind of disasters, frankly. They borrowed money from the government and loaned it out at a couple % more and tried to make money on the spread, which isn't really venture capital. But a few of them kind of learned about venture capital and spun off and started venture capital firms. And so Brentwood down in Los Angeles was a spin out of a Westland Capital, and Hambrick and Quist up here, an investment banking firm, George Quist spun out of Bank of America. So some of the SBICs actually had bank roots, and so there was an early venture industry out here. And then along came some more angel investors, some people like Arthur Rock and Reed Dennis, to form what was basically a band of angels back then. And we're now talking about in the 60s, early and late 60s. I intersect with that because a fellow named David Morgenthaler was silly enough to recruit a guy named Bob Pavey out of business school in 1967 for a company he was running in Cleveland for J.H. Whitney. So his roots in venture capital go back to J.H. Whitney, a New York firm. He sold that, as you all expect to do, for a lot of money and made enough money to become an angel investor. And I joined that company out of business school. And then a couple of years later, in 1969, joined Dave. We were in Cleveland. That's where the company was. It turns out that wasn't the center of venture capital. So what did we do? We spent time on planes. And we either flew to Boston, sometimes to Ann Arbor, and a lot to California, where the opportunities were. And you know, I'm a kid. I didn't know California, but there was stuff going on in this area around Stanford, and there was a little bit going on down in San Jose. And believe it or not, there were actually farms in between. It's amazing how this place has changed.
So could I ask,
Please.
Was this where it started? No.
No,
what you're
no,
saying is
no,
it actually
didn't start here.
Oh, amazing!
Right,
I didn't know that.
Started in New York, you know, where most financial things kind of start, but not with investment banking. It started with kind of wealthy families.
Okay.
And Venrock and Whitney had their offices, their family offices in New York. In fact, the Rockefeller family still has a family office that invests in public stocks, and it also invests in Venrock, which does venture capital. And then, I mean, the step I left out was a fellow named General Dorio up in Boston, who was actually a professor at the Harvard Business School, decided this was kind of interesting, and so he started a group called American Research and Development, if you looked at the history of venture capital. And it was actually a public venture capital entity. And what happened, they got lucky. They backed a little company that was in the controls business, and Dorio was opposed to it, but the CEO convinced the board to morph the company into doing something called small computers, mini computers, and this company became Digital Equipment. And American Research and Development made almost 1,000 times its money, I think 700 times its money on its research in digital equipment. And, you know, people saw that and they said, gee, that looks like fun. And so pretty soon the venture industry started to grow. But it was industry, and gee, I didn't want to give a speech, but the industry was very small in the 70s. I'm talking the whole national venture capital industry invested about $100 million a year. And that's, by the way, venture and buyouts. There was no separate thing. So Whitney and Venrock, they do a startup and then they'd buy a company and change it. So they did both. And what happened in the late 70s, about 78, the venture industry had formed something called the National Venture Capital Association, which you mentioned earlier, which is sort of our association. And some of the early leaders in the venture industry, which included Dave Morgenthaler, there were 20 of them, got together and sort of said, well, you know, what can we do? And, you know, should we meet and fix prices and beat up the entrepreneurs? Well, that wasn't legal, so you couldn't do that. And Dave and another gentleman decided that the environment for entrepreneurship and venture capital was so poor that they would go to Washington and try to see if they could change things. I mean, it was a brash thought. Who would think that a few people could do that?
Yeah.
But it turns out in 78, I think I got my year right, Jimmy Carter realized that he needed to do something to help small business. And he anticipated that he was going to reduce the taxes on dividends. He didn't know small growth companies don't pay dividends. They don't understand entrepreneurship very well in Washington, as we've all found out. But Dave, actually, my partner, and a fellow out here from the American Electronics Association went to Washington and they wrote, there was a white paper that they wrote, they started testifying, and they convinced a congressman to introduce the Steiger Amendment to roll back capital gains taxes. And that happened in 78. And capital gains taxes went from being higher than ordinary income taxes, which is where we were before that, to lower.
Wow.
And then, of course, along came Reagan and reduced ordinary, and capital gains went down with him. And so we had this great capital formation wave. And another important step, I promise I'll stop quickly, was that another group from the NVCA went into the Department of Labor and convinced them to change the definition of prudence. Maybe our attorneys here can help us understand that, but there was some new thinking around investment management that said that to be prudent, if you're running a large pool of capital, you really should diversify. You shouldn't put it all in debt if you're trying to reduce your risk. In fact, if you put it all in debt, the only thing you know is that you, over time, will not keep up with inflation. You'll lose money. So what did it mean to diversify? It meant diversify by industry, it meant to diversify by geography, and it meant to diversify by risk. So all of a sudden, it became prudent to take a small fraction of a large portfolio, be it the Stanford Endowment or the Harvard Endowment or Cal STIRS or whatever, and put it into venture capital. Well, so now we take this little $100 million industry, that's what, $2 million a state. California probably got a little more than its share, but there wasn't very much money. And money started pouring in. And the industry went from 100 million in 78 to about 5 billion in 83. It grew 50-fold in 5 years. Wow. And everything that happens when industries grow too fast happened. There were a lot of dumb deals made. A lot of people sucked in. A lot of dumb guys like me were sucked into the industry. And we had an opportunity. Yeah. And that's when it started to grow. Back to your original question here in California. Yeah. Entrepreneurs left the banks and raised money. Hambrick and Quist started their own venture capital fund because George Quist had some experience with an SBA. And the technology was already developing out here. You had Hewlett-Packard already, and you had the semiconductor industry in its very early stages. And so this combination of new capital with an existing business environment began to blossom and create all kinds of opportunities. And I mean, one of our earliest companies, you'd have called it a cloud software company today. It was a time-sharing software company back then. And one of its largest time-sharing suppliers was a company called Timeshare out here that operated time-sharing on XDS 940s, believe it or not. And we bought a bunch of their capacity, and we came out here and worked with them. And they were down in San Jose. And so we started spending more time out here, making investments out here and co-investing. That little company that we invested in turned out to be a fabulous success. We made 100 times our money on it. It was an Ann Arbor-based company of all things. But we got, when we couldn't raise any money, we convinced Bill Hamrick to put all of their funds into it. And it's very simple to make friends with an investment banker. You just have to make them some money. Pretty soon they convinced you're an okay person. And so we made money for Hamrick and Quist. We got very friendly. We started co-investing with them out here. We spent more time out here. Got to know Reed Dennis. Got to know all the early venture capitalists out here, and watched it grow from a pipsqueak industry into an overgrown industry by 2000. But we can get to that later.
So I gather then what I'm hearing is it really was a combination of the money and the technology in this area that made
the technology came first.
Right. Okay.
I mean, the weather's nice.
Yes.
The fact that, but the fact that the money grew and prospered here was because there had been some successful angel investing. And if you really want to know ancient history, there was actually a very active venture capital period when there were no venture capitalists back in Cleveland 100 years ago. It was all angel money.
Right.
But what happened in Cleveland, they discovered oil in western Pennsylvania, buggy manufacturers started making cars, machine tool companies, all of that stuff grew in an earlier wave, and it was driven not by capital, but by technology and entrepreneurs and entrepreneurship and angel investors. One more fact.
Yes.
Today, in this country, we start 700,000 new businesses a year. There are a lot of lawyers, there are a lot of doctors, there are a lot of dentists, there are a lot of restaurants, there are hairdressers, there are everything. 700,000 businesses. About 10% of them raise angel money, 50 to 70,000. 1,000 of them raise venture capital. One out of 700. I mean, we're still small, even though we invest about $20 billion a year. The average company consumes about 20 million times 1,000 companies. That's 20 billion. We're still not the big drivers of entrepreneurship. We're the source of capital for companies that need serious money.
Right.
If you have a business that's, I was just reading this material here that start with some understanding how much capital you're going to need as you put your plans together and sources. And if you're smart, decide to say you don't need venture capital, because we're hard to live with sometimes, and we're hard to get attracted to your business. But our role, our raison d'etre in the economic scheme of things, is to finance companies that need tens of millions of dollars.
Right.
Angels finance things that need $1 million, and your parents finance you if you need tens of thousands of dollars, or your buddy, or your savings, or whatever.
Right. And so I gather what I'm hearing is really the venture piece is all about scaling.
Yeah, it's all about
That's the
scale.
major piece, the
That's
highest
exactly right.
priority.
Yeah.
And if you're not going to scale the business, either run it lean or go
Absolutely.
to angel investors.
In fact, if you're really smart, have a couple of plans. Here's how I'm going to run lean.
Okay.
If I can raise venture capital, here's what I think I can do with it.
Okay.
But if I can't, I'm not going to die.
Okay.
I'm still going to build a good business. It's just going to take more time and go more slowly.
And from what I'm hearing too, the odds of you getting venture is like 100 to 7. 1 to 700.
1 out of 700. Yeah. No,
not very good odds.
Not for these people, because they're much more talented than average. But a lot of those 700 don't try. I mean, if you're going to start a little restaurant, you don't raise venture capital,
Yes,
or a hairdresser or whatever.
And you did mention that sometimes it's hard to live with your VC. Do
Yes.
you want to give me a few things that you've seen over the years of the challenges for an entrepreneur with
Good
VCs?
question.
You don't have to mention names, obviously.
Well, I'll mention my own name. I hope I'm easier to live with than most. We talk about venture capital as financing dynamic growth in companies that need capital. Raising money from a venture capital is a little like being a flower in a hothouse. You get a lot of fertilizer dumped on you. You get well fed with money or whatever else you need.
Yeah.
Many flowers, if you take them out of the hothouse, they don't survive.
Yeah.
They get overstimulated. So the first problem with venture capital is if the company really isn't ready, and we make a mistake and jump in too early and then try to force feed it and encourage it to grow too quickly, you'll get a mismatch of capability and capital. And pretty soon the venture capitalists will be unhappy and the entrepreneurs will be unhappy. And then the venture capitalists by then may have a majority of the board, so they may change the entrepreneurs. If the business wasn't ready, that really won't help.
Yeah.
If it was, the entrepreneur just wasn't able to grow the company, then a change may help. But most of our successes, even though I'll be honest and admit we change entrepreneurs sometimes, come where we don't have to change entrepreneurs. It's where the fit between the flower and the fertilizer are perfect, and the thing grows and prospers very nicely. The other problem that you run into is that almost all firms raise money from more than one venture capitalist.
Yes.
In part, I think that makes a lot of sense, because entrepreneurs aren't looking for a boss, and if you got one venture capitalist is your only source of money, you're a little like a boss, even if we're not bossy. But so you have a board of directors. If you need 20 million over several years, you might raise it from 2 or 3 venture capitalists. They're on the board. It's just like a bank syndicate. All it takes is one to panic, or to have something wrong in their firm, or have no more money.
Yes.
To sort of start to make it harder for the firm to interface with the venture capital group.
Right.
And that's why it's really important to try to find at least one venture capitalist that you're really compatible with, where you think you can work with them, or you can form I use the word partnership a lot. It's a little like getting married. There are challenges, there are problems, there are fights.
Yeah.
There are things that happen in real life, and it's what happens in a venture-funded company also.
So on that point, because I'm always interested in the matching process between entrepreneurs and investors, what would you say from your experience is the highest priority from your side as an investor looking at an entrepreneur that you might possibly marry or partner up with through venture?
Well, the number one issue is trust.
Okay. And how would I gain your trust if I was an entrepreneur coming to you? What are the key points that you're conscious of that you would be noting if I was pitching my business to you?
Well, so the communication medium ends up being your business plan.
Okay.
And I don't mean it needs to be a 50-page document. It might be just 15 PowerPoint slides.
Okay.
With some financial backup or whatever.
Yeah.
And the first thing I do when I'm talking to you is I ask you to do what you asked me to do, which is tell me the story of your life.
Okay.
Yeah. Is it credible? Are you overstating things?
Yep.
Is there a little humility there
Yep.
that makes some sense?
So you're making some value
You're
judgments,
making judgments about the person. Absolutely.
Okay.
And if I'm not interested in working with the person, it just doesn't, it's a short meeting.
Got
frankly.
it. Got it.
And now, if I was convinced it was going to be Google, I'd put up with anyone. But you don't know that going in. And in
Exactly,
fact,
that's
the story
the risk,
is
isn't
that
it?
both Kleiner Perkins and Sequoia, after being in Google for 1 year, tried to sell their interest.
Interesting.
It wasn't going well. They thought they'd made a mistake.
Interesting.
So you don't know.
Yes.
You form a judgment. In the case of Google, pardon me, little pineapple in my tooth. In the case of Google, there was an angel investor that brought them in, and he got involved also. And so there were some good angels, there were some good venture capitalists, and it all worked. But I'm looking for somebody that I trust, somebody that I respect, based on the discussions we have. We have a good intellectual fit, somebody that I think knows what they're talking about when it comes to their business.
Yes.
If you've been doing one thing and you come into my office and say, I'm going to do something entirely different, well, what do you know about that space? How many semiconductor company executives decided they were going to become clean tech executives? It often didn't work very much because they didn't really understand the energy business very well. So, trust, respect, and a reasonable plan. And frankly, the other thing that I really encourage entrepreneurs to think about is, as a venture capitalist, I'm going to make about one serious investment a year.
Okay.
Why? Because I can be involved on 5 to 7 boards at a time. There are a few people who claim to be on 15 to 20, and they just don't sleep, I guess. They're much better people than I am. But really, 5 to 7. If you think about it, the venture industry, as I mentioned, finances about 1,000 companies a year. I think there are about 5,000 professional venture capitalists right now. So the average person isn't doing one a year. Pity the poor entrepreneur that gets 5 of them, because then they'll be doing this all the time. So it's a matter of a fit between my time, my interest. Most venture capitalists kind of have a hypothesis. They're working on, financial technology, which is where a young partner in our firm financed a company called Lending Club, which is turning to be very hot and very exciting right now, and she's done other financial technology deals. So I'm working on a hypothesis at any point in time about where I'm interested. If you come in and you seem to have background in that space, you can say, I know some of the other companies you financed there, I think they're very interesting, and we can develop a dialogue, and I think I can learn from you, and I think you'll listen to me. Then we might get something done.
Right, great. And I know you did mention to me that your main focus personally is the mobile area.
Right.
Do you want to talk a bit about some of the investments you've done and how you see the mobile area going in the future?
Well, we look for ways, and I mentioned the mini computer industry all the way back for General Dorio and American Research and Development. Our firm actually, since I got in the business in '69, made a few late-stage, real-time mini-computer investments. Then it looked pretty clear to us that the next major wave was going to be PCs. And we poked around, and went up to Ann Arbor to some company you never heard of and talked to them and bought one of their PCs. And there was a company in Ohio, in Cleveland, called Ohio Scientific. It was making PCs. And fortunately, I got lucky. I concluded that Apple was going to be the best company, and we invested in the second round at Apple, and it worked out reasonably well. Well, the same thing happens as you look beyond that. The next major wave after some desktop and other things, the next major wave, it seemed to me, is just going to be these things. And that they have more power than the PCs did. We all use them for communication, they manage our lives anymore.
Yes.
And there are over 1 billion of them now sold worldwide,
Right.
which is an amazing number when you realize that there are only 300 million people in the United States. And we're already selling more smartphones, high-end smartphones, than there are people in the United States worldwide. And so I've been looking at some of the companies that can ride that wave. Can't invest in Apple again, it's too mature, and Samsung's a little away from me also. And, some of the other Chinese companies, Lenovo just bought a chunk of Motorola from Google. So there's lots of changes going on, but there are semiconductors that are needed, and even though semiconductors are a bad word, I've backed a couple of companies that are going to make the front-end RF in these devices more efficient.
Oh,
And one of them is now public, another one is still private. And I've made an angel investment in a company that's going to do a next generation camera module. Because in fact, more and more, people don't carry cameras.
yes.
A sideline, my wife and I took a vacation last year and we went down on the National Geographic boat, we went down to the Antarctic. And there are 100 people on this boat. There are about 30 of them with cameras, this long. You never get to see their faces because they always have these great big cameras. But a lot of people are taking amazing pictures with these things because they can interact with the environment. They can use them. They can save them. They can send them to their friends right away. And
Easy to carry around.
and or they take them with those devices, the
Yes.
iPad, right?
Yeah.
And I left mine in my car, but I pull out my iPad Mini. It's a great camera. So that's kind of what I'm doing, and our firm is investing in software companies, in tougher areas, been advertising technology companies because we're starting to get ads on these devices. There are all kinds of places, and almost every software company some of the fintech companies, for example, are developing apps that are used. I mean, another of our very successful companies, again, not mine, is a company called Evernote, which has done really well. And I was out for dinner with friends over the weekend, and he brought a bottle of wine that I liked, so I just took a picture of it and sent it to Evernote. And then whenever I want to find that again, I won't remember what the wine was, I might remember the date, I might remember the restaurant, I can pull it back up and have it. It's my own Google.
Yeah, your own database.
So this device is driving opportunities, software applications, tools. Another of my partners has done next generation cloud-based database company that's going to support all sorts of mobile. So it's changing everything.
Right, so we're going to do a Q&A so everyone in the audience can ask questions, but I've got one more question to ask you. Very briefly, what's your experience with foreign startups or foreign entrepreneurs at Morgenthaler? Do you invest in anyone outside of the area? I know most VCs don't like to invest.
We try to invest here,
Yeah.
but it's been a long time since we've backed somebody who was born here.
Interesting. So that's that system of everyone has to move here and then get their funding.
Yeah, well, that's right. Now, personally, I've been lucky. I've made a little money in life. I've actually invested in a couple of Chinese venture capital firms to make sure I understand what's going on there, and some firms in India also.
Right.
But we believe that you got to be able to have breakfast with the entrepreneur.
Yep.
Board meetings are nice, but as I said before, you get lots of people coming. And look, if you're going to give the entrepreneur some criticism, I think you're really screwing up here. It's better to do it one-on-one over breakfast as opposed to in a meeting with a bunch of other people. It's just a real world.
And I know lots of VCs compare it to a marriage, so I guess it would be a bit of a weird marriage if you were living thousands of miles away, right?
Yeah, some people try to do that these days.
Exactly.
And some people make it work. I think
Yeah.
they're better than I am.
Okay, so open up the floor to questions. Please feel free to ask Bob some questions. Andrew.
Hi, Bob. Question for you. With your experience of being in Cleveland as well as early success in Ann Arbor, I want to ask you what you think the dynamics are now, and maybe even historically, on VCs investing in companies that are outside of like the core. I mean, these days it's not Boston. I saw a statistic saying 84% of media tech companies that are having exits are in the Valley, in the Bay Area, and New York City. So everything outside is different valuations, different burn rates. What's your perspective on that? Is it an opportunity to invest in a Cleveland-based company with a lower burn rate, or do they need to come here to meet with bucks?
Well, I mean, one very successful venture capitalist out here moved to Ohio and has raised a $250 million fund. And he's found several interesting investments. We found interesting investments. Like any other business that's kind of supply and demand, there's more supply of venture capital out here, but if the supply is 10 times as great as it is in Ohio, the demand's 100 times as great. So the supply-demand ratio is still better, and that's why we've largely moved out here. When we were in Ohio, we did a wider range of things. Cleveland has become a bit of a center for the life sciences and biotech. There are a number of young companies there that are doing well. That's just not my area. Ann Arbor is still, around University of Michigan, a kind of a mini entrepreneurial center around computers and information technology, as is Pittsburgh. And so there are small centers of excellence, smaller than here, around the country that are doing well, and obviously around the world now, Shanghai, Mumbai, wherever. And I think there are going to be more and more opportunities for people to build local firms and invest in those people. This will still be the center of mass for that activity, though, I think, at least for the foreseeable future. I once gave a talk to a bunch of venture capitalists, and I mentioned my Cleveland analogy of 100 years ago, and I said, now, you guys just remember, Silicon Valley's hot right now, but 100 years from now, it might be the next Cleveland. That's what got printed in the result of that. My Cleveland friends didn't like me, my Silicon Valley friends didn't like me. You got to be careful to protect this goose that lays these golden eggs.
Yeah. Thank you. Anyone else?
Yeah, I was curious to know, have you ever been interested in investing in energy efficiency or transportation? They all work with mobile tools, mobile apps today.
Mm-hmm. A little bit. We looked at energy at the time that we looked. Kleiner Perkins moved into it in a big way, as did Vinod Khosla and Morgenthaler and then some other dedicated firms. Most of the things we saw were too capital intensive. It's the cylinder problem. And by the way, it was interesting technology, but one of the things you've learned in venture capital decades ago is we can't finance fabs. Remember, we put up tens of millions of dollars. A semiconductor fab requires billions of dollars, and a solar fab requires hundreds of millions of dollars. That is not venture capital, except in very unusual circumstances where a lot of VCs come together or some very big ones get in. That much money needs to come either from a corporation or from the government or some other source of really big money. I've done a little angel investing in the space. I've backed a company that's in the battery management area. And my most recent investment is a company that's doing solar thermal, which is basically using very old technology to take advantage of solar mirrors heating a fluid. So I think there are going to be opportunities, and there will be more opportunities that are capital efficient. But they have to be capital efficient, i.e. need millions or tens of millions of dollars to make sense for venture capital.
And what about the ones that are not capital intensive, like the apps and the interfaces?
Oh, absolutely, yes, there are opportunities there. Yeah.
Hi, I'm Ziad from Tunisia. How much time would you spend with an entrepreneur before deciding to invest?
That's a good question. And boy, talk about a wide spectrum. The longest I've spent with an entrepreneur before deciding to invest was an investment I made, probably shouldn't have, in a company called Midway Airlines. Airlines shouldn't be backed, I just said, by venture capital. Worked with them for a year, and a bunch of other venture capitalists did the deal, and I went in also. The fastest I've ever invested was Apple Computer, because we found they were doing a round. By then I'd done a lot of work in the industry, and I knew the people, and we found on Friday they were doing a round, and we committed on Monday. If we hadn't, we wouldn't have gotten in the round. So it's like anything else, it's competition, everything else. Normally, how much time, if I asked you how much time you think you ought to spend with somebody before you decide to marry her or him, the answer would be, I don't know, maybe a few months, maybe 5 years. It's a matter of building trust. We often will meet entrepreneurs and say, gee, it's not a fit for us right now. Go forward as an angel, see if you can raise some other smaller money, and then let's keep talking. Let's build that trust, which is that number one requirement. See if you want to work with us, and see if we want to work with you. I wish there were a better answer. When one of my companies is going out to do another round, and they're going to raise it from additional venture capitalists, I say you better start working on that 6 months ahead of time.
Thank you.
Hi, Bob. Just curious, with your experience, right now we're seeing what could be called a big change in the venture capital industry. Traditionally, it's kind of the model hasn't changed for 30 years. And now we're seeing these firms that are kind of marketing themselves more as service agencies, have a platform to work on, and feel that's more scalable. Some have even gone as far as using the Hollywood analogy, that an entrepreneur's no different than a Hollywood star, and you just got to put all these people around them to prop them up and help them out in the areas that they're maybe not strong in. We saw a bit of this in the dot-com boom as well. Do you think this is just another fad that will go away like it did in the dot-com boom, or do you think that the model is actually changing right now?
It's kind of trite to say, but I think the more things change, the more they stay the same. Back in the very early days of venture capital, most companies were backed by a group of angels that would provide things that they couldn't provide, and they'd find friends to help and the like. Certainly there's a lot of very active angel groups that are helping companies today. I think that's a very important and a useful function. There were similar kinds of groups. They weren't called angel groups 40 years ago. We got to a period when, I didn't mention this, although I didn't explore it anymore. By 2000, the venture industry was investing $100 million a year. And by the way, the buyout industry that had sucked in more money was also investing $100 billion, pardon me, I said million, billion, $100 billion a year in about 3,000 to 4,000 companies. It made no sense. Our economy doesn't create enough companies to consume that much money. So as an industry, we created 3 where there should be 1, and they beat each other up. And so at that stage, a lot of venture capitalists were saying, I don't want to work with angels. I want to be the very first money in. I want to carry it all the way through. That's really not natural. That's not the way it ought to work. I think it's kind of back to where it ought to be right now. Some people will tell you there's too much venture money. Some people will say it's overheated. Others in other sectors will say there's not enough. My sense is we're investing 25 or 30 billion a year right now in 1,000 companies. As I said before, about 25, 30 million per company over multiple rounds. That's probably about right. And there's opportunities for angels to get a lot of these companies started, and groups to work with entrepreneurs and and build them up to the point where they ought to raise venture capital.
Anyone else? How much time we got?
Any questions from afar?
Sorry? Okay.
What kind of market traction would you like to see before you're interested in looking at a company?
Market traction? It depends on I like the more the better. Assuming the valuation isn't too high, so I can still buy enough of it. We like to own 20% of companies. And in the end, if we're going to invest $10 million for that 20%, then the company has to have, over time, be able to be valued at $50 million if $10 million is going to buy 20% of it. And what's more, if we're going to have an opportunity to make 5 to 10 times our money, which may seem like a lot, except if you realize that half our investments die or don't do very well, that the investments we need to finance things that can be worth, companies that can be worth $250 to $500 million to make our economics work. Back to your question, the more traction, the better. Sometimes if it's a startup, we'll put in $1 million and work with them where there's no market traction. The more normal thing is that companies ought to raise that first $1 million from some angels, get a little traction, talk to us. Maybe it's not ready for us, maybe it is. We'll work together, try to give you some help, and over time then maybe invest.
Do you look at early stage even before products are completed, or?
Oh yes, yeah. I mean, we mostly as a firm do A and B rounds, and we don't do as many seeds. We do some, but even the A rounds often there's an immature product. B rounds, they tend to have more real revenue and some serious traction.
So we've been, some of the VCs that couldn't make it today donated some great books on venture. And I just wanted to ask, we're just going to have some fun questions, but can anyone remember what Bob's highest priority when an entrepreneur pitches in to see if there's a match? What's the word he used a couple of times?
Trust.
Who said it first? Sorry. Who said trust first?
Who's going to appoint?
Well, I heard it around here somewhere.
Yeah? So this is from Jeff Busgang in Boston. That's a fabulous book. And Brad Fell sent startup boards. And so the question I'm going to ask was, what did Bob say that where the venture capital industry is investing per year? How much?
$100 billion.
No.
Not anymore. That was at the peak in 2000.
5 to 30 billion.
Yeah, you're right. So that's a great book too. Thank you. Anyone else got any questions, Bob, before we lose it?
Anything in particular in mobile that is sort of fascinating you? Payments, anything that you think is really exciting and is the next wave in mobile?
Yes, and there's a couple of them, and there may be a little overhyped in each case. One is wearables. I mean, that's clearly a next dimension of mobiles. It won't be in your pocket anymore. It'll be on your eyeglasses, or on your wrist, or maybe even implanted in your skin. It's going to happen. It's one of the things we try to say is, what's going to happen, and then can I find a way to invest in it and make some money at it? That's harder right now. A version of that is the Internet of Things, the machine-to-machine world. Absolutely, it's happening. It's going to happen more. It's pretty clear that it won't be long before our cars are talking to each other, and if that car is coming too fast, it's going to tell my car it's also approaching the intersection that it's coming too fast. Be careful. By the way, to me, how do you reduce your healthcare costs in this country? You probably don't do it through the government. We need their help, and everybody needs healthcare. I think we would all agree on that. The way you reduce it is by fewer automobile accidents, and And that's going to change. There'll be some serious changes when we get some really smart cars out there. You know, cars talking to cars. It's one thing to have the, your lawn sprinkler talk to the internet so that it knows whether to water today or not because it's going to rain. That's the obvious example. But then the Internet of Things it's a company by the name of Guess just got valued at $3.2 billion making thermostats. Yeah, it was a pretty good valuation. I wish I'd invested in it. But it was well engineered, and it certainly talks to the internet. And more the Internet of Things, wearables, these are going to be the really important next generation devices. And they're just going to be smaller and smarter. And they're all going to have, most of them are going to have not only the ability to speak various frequencies, but they're going to have GPS capability, they're going to have Bluetooth capability, they're all going to have concurrent multiple frequencies going on. This is really complicated stuff, and it's creating opportunities.
How are we doing for time? Okay, one more question.
There's been some debate about, platform versus mobile versus hybrid. Do you have any thoughts or feelings on companies that are developing platforms versus just strictly mobile or hybrid, things that you like to see as an investor in terms of that mix?
I think it's all happening. Mobile, I gave the obvious answer, but the other thing that's clearly happening is the cloud. In order for mobile to work, the cloud has to work because all these devices don't really talk to each other. They talk to the cloud and back down. So lots of database stuff. I'm not sure I caught all the words you mentioned, but am I answering your question?
Somewhat. I'm just wondering if you have, how you view companies that are developing platforms first or mobile first, or how they're integrating it, or just what you like to see in terms of a rollout strategy to the market.
Yeah, it's really got to be company specific. I've got an investment in a young Internet of Things company called Ayla, which is down there in the peninsula, and they have both the cloud tool and a very small client. They're in the software business. They're selling their hardware through Broadcom and Microchip and others because they're going to be the ones that are going to make the very inexpensive hardware. And these guys have interesting software and platform software to take advantage of it. And how they market it in the end is going to be through partners because they can't do it themselves.
Okay, Tom, yeah?
VC firms seem to have a history of following trends. How do you look at companies that really don't have, or even industries that really don't have a history of investment, or there are no analysts in the industry?
Yeah, that's a good question, and it's hard. And it's right now it's a problem with the semiconductor industry. There's very little venture capital going into it. We've lost many of the analysts. Certainly, if you move from that to automobiles, where I said earlier there's going to be enormous change, it's not an area where venture capitalists have any experience in investing. And you move from there into robotics. Venture capitalists were, including my firm, I made a couple of robotic investments, and they weren't very successful. We lost our money. It's hard to make money when you have a negative gross margin. You can't make it up in volume. Machine tools and robotics, and a very hot area right now is 3D printing. Well, that's basically a machine tool and a printer kind of combined together. It's a tough area to make money. So there are a lot of sectors that venture capitalists are just going to go very slowly into because they don't know how they're going to get valued. And remember, the deal you make with the devil when you raise money from a venture capitalist is you promise to give him liquidity. We're not in the business of owning these companies forever. We raise money from institutional investors, and they want to see it back in less than 10 years. So you can't build a small company and spend 25 years building it and expect you're going to have happy venture capitalists, because they're going to have unhappy limited partners. So we look for things where they're there is, where there are analysts, where the public market is interested, or where there at least is acquisition interest. And other industries where that doesn't exist are mostly going to have to find other ways to get financed. Right now, if you're a semiconductor company, I suggest go find a Chinese investor. There's more money over there than there is here for that kind of hardware deal. And that's probably true for energy and for several other sectors right now where there's more money in China than there is in the United States.
Bob, that also makes me think about the question that what I've noticed is sometimes there's often a leader in an area, say like 3D printing or robotics, and they often fail, that first company.
Right.
And then, I don't know how many years, because it varies with different industries, but then all of a sudden it'll take off, and that first leader company will actually make a lot of money and be a great investment. What do you think that's all about? Is that about breaking the ground and testing? It's almost like they're a sacrificial lamb, that first one, right?
Yeah, it depends. I mean, the first venture capital company in the biotech industry that I was aware of was a company called Genentech.
Oh.
They just took off.
Oh,
Then
okay.
it looked easy. The first robotics companies were disasters.
Yes.
And certainly that's happened in the solar space at this stage. They've almost all been, with very few exceptions,
Yeah.
problems. So I think it depends on the sector.
Okay.
There's an S curve in almost every new industry, and so those that get in early take a long time before they reach that rapid growth period. And one of the trite sayings in venture capital is being too early is the same as being wrong.
That's what I'm thinking, yeah. And it's almost that crossing of the chasm, isn't
Yes,
it? Really?
exactly.
Yeah.
Yeah.
Okay, great. Look, thank you so much, Bob. I've learnt so much today. I hope you guys.
I hope I didn't bore you guys too much.
Not at all. Thank you so much.